When looking at a real estate portfolio, oftentimes it consists of a variety of types of properties. It might have rental properties, maybe there's some commercial properties, a family cottage, vacation homes, etc. And I find there's two main things that are typically tracked within the real estate portfolio. And number one, it's the current fair market value of all properties. And most people are pretty aware of what each property is worth. The second thing that is typically tracked is the purchase price, the ACB. And that might include betterments and improvements. So you bought it for X, you've added Y, and now the ACB is worth XY. But one thing I find that is not tracked or rarely tracked is what is the capital gains tax bill going to be on these properties? Now, I'm not talking about your principal residence. I'm talking about all secondary properties, being rental properties, family cottage, commercial units, vacation homes, etc. And within those properties, there is very often a capital gains tax to be paid when that property goes and gets passed down to the kids. So principal residence, tax-free growth, there's no tax bill waiting when you pass your principal home down to your children, grandchildren, etc. But when it comes to secondary properties, it's a very different story. If there's been appreciation, which most likely there has been, that means there's going to be a capital gain. And that capital gain is going to be taxed. And 50% of the capital gain is added to your final income in the year of death. And assuming a 50% tax bracket, 50% of that half would be owed in taxes. So for clean math, and just, as a quick way to calculate what the tax bill could be when you pass away, it's typically 25% of the entire capital gain. So if you have a real estate property worth $20 million and your purchase price is $10 million, let's exclude betterments and improvements just for argument's sake, that means there's a $10 million capital gain between 20 million and 10 million. Half that becomes taxable and half that becomes owed in taxes. So 25% of that total 10 million or 2.5 million would be owed when this person passed away and went to give the properties down to their kids and grandchildren. Now, if there's a spouse involved, of course, it's a tax-free rollover. It can be a tax-free rollover, but we're talking about when assets go down to the next generation. So the question is, first of all, calculating and being aware of what this tax bill is going to be. Second of all, what is the most efficient way to pay for this tax bill? Because if you're working your whole life to build this real estate empire, I highly doubt you're going to want to lose a significant portion of it to taxes, just pretty much due to poor planning. So I'm going to walk you through a few different ideas as far as how to calculate the tax bill, and most importantly, how to pay for this tax bill in a very efficient manner. Now, the first way to pay this tax bill is, of course, to just sell a pretty big portion of your real estate portfolio to have the liquidity to pay and keep the rest of the properties. So it could be on a maybe 3-for-1 basis. So for every 3 properties you own, you might have to sell one to keep the other 2. And by selling one, yes, there's tax on that property, but you're getting liquidity in cash to pay the tax bill to keep the rest of the property. So if you had 20 or 30 properties, it might not be far-fetched that you'd have to sell 5 or 10 properties to keep the other 20, let's say. So most people I find and I speak with who have these real estate portfolios aren't interested in selling a significant portion of their portfolio just to keep the rest. It's counterintuitive. They've worked their whole life hard enough to buy these properties and acquire this portfolio. They don't want to lose a big chunk of it just due to poor planning. The second option could be just using cash. Now, if they had, if they're sitting on a lot of cash in their checkings account and the tax bill was 2.5 million and they had 2.5 million sitting in cash, yes, technically they could tell their executor to take the 2.5 million, pay off the tax bill, and all the properties would be kept in the family. And it's true. That's one way to solve this problem. I would argue that using cash to pay a tax bill that's only owed in your estate is a very inefficient use of your money. It's an extremely inefficient use. In fact, it's pretty much a waste of money of doing it in cash. The third option and far more efficient use of your money would be buying a life insurance policy for $2.5 million. Now, if you think of it, whenever you buy a life insurance policy, you're putting in a smaller amount of money today to get a much larger payout in the future. So if the payout is going to be 2.5 million in a life insurance policy, it's not going to cost you nearly 2.5 million in premiums to get that payout, because you only need the money pretty much the moment you pass away. This taxable isn't owed while you're alive. It's only owed when you pass away and go to give the properties down to your kids. So if you were to, even if you had that money in cash, I would say keep, a bit aside to pay for the premiums, but the difference, go spend it during your lifetime, go buy more properties, go do something with that difference, and only keep a portion to the side, and you can slowly pay into insurance premiums. But ultimately, you're going to end up with the same end result, that same 2.5 million being paid tax-free to pay this tax bill. And there's a variety of ways you can fund these premiums. Some people just pay out of pocket every year. Some people pay the premium and then borrow it right back so they can continue using that money to buy more properties, but they still have the life insurance. And I have other videos on that strategy, but there's a variety of ways to fund your premiums, your policies, but most importantly, you've solved the problem of paying for this capital gains tax bill that isn't going away, but you've done it in an extremely efficient way. And now you're able to keep all your properties and continue to acquire them without the fear of pretty much having your estate in a massive disaster, forcing your family to perhaps fire sale properties. Depending on the timing of the market, it could be a very ugly scenario. So if you have a real estate portfolio, please be aware of not only just what the fair market value in the ACB is, but what is that total taxable capital gain going to be owed when you pass away. You might have to project in the future, because we're only talking about the tax bill as of today. If you still have 20, 30, 40, 50 years to go, that tax was going to increase. So plan for it, be aware of it, and speak with a professional to determine pretty much the most efficient way to pay this tax bill and keep the properties in your family forever. Thanks for watching.